good evening, everyone. I think that introduction there, a lot's expected for the last panel of the evening. We hope it's an enjoyable discussion before everyone moves on day 2 of the conference. Hope everyone's having a great conference, and it's a pleasure to be with you today. So as mentioned, our panel today is focusing on the second act. So welcome to the overall panel. How investors are rewriting the story of hospitality assets. Today, we explore how capital is reshaping the hospitality landscape from repositioning legacy assets to reimagining operational hotels. With us are 3 leaders actively writing this next chapter, and I invite them on stage. Please give them a warm welcome.
Jamie.
So I'll ask each of our panelists to give a brief introduction on their current role, their company, and their activity in the market at the moment. Jamie?
Thanks, James. So my name's Jamie. I'm a vice president at Aleo Partners. Essentially, Aleo Partners is a boutique real estate-focused debt and equity advisory business. So essentially, we support owners, investors on either raising equity or finding opportunities or raising the debt against their assets.
Thanks, Jamie. Vijay?
Thank you. Vijay Raghavana, board member of the Arenco Group, Golden Sands Hotels for this hospitality division, perhaps the largest non-government real estate and hospitality owners in Dubai. Pleasure to be here.
Mr. Oliver?
Oliver, CEO of Arzan Investment Management. We're an investment manager based out of London and Dubai. Global mandate to invest in all real estate classes, but specific focus on hospitality and residential.
Great to have you here. As you can see, we have esteemed panelists with us here today. We're very active, especially in the investment market at the moment, which has really heated up over the last 12 months in particular. Oliver, starting with yourself, what's your investment framework at the moment for assessing hospitality assets, especially on the repositioning side?
Yeah, like we look at hospitality here in Dubai as against any other asset class we could invest in here, both locally or globally. And so from a risk-adjusted basis, we want to make sure that we're getting paid for the risk that we see that we're taking. And we compare that against, or benchmark that against what we could find in, say, US, Europe, or elsewhere. And so we prefer to be on the more sort of opportunistic end of the spectrum here, looking at assets where we can get our hands dirty in repositioning, value add. If you look at one of the hotels we just acquired, which is the Fairmont on the Palm, It opened about 15 years ago for various reasons. The previous owner hadn't invested into the asset at all because of the whole Palm. There's a lot of construction, courtesy of Vijay and his guys, going on in the neighboring assets. And so, that repositioning of the Palm as a destination, if you look at what it was when it opened to what it is today, the asset needs to change. And so, our view on that asset is, as well, it's been incredibly well run in recent years. It now needs a lot of work on CapEx, renovating it, repositioning it into what we think the Palm is today and will be for the next 10, 15 years. As that sort of supply has come to the market, the market has matured, as the whole broader Dubai has matured. We feel that we can very comfortably now underwrite risk-adjusted returns that will deliver us a great outcome for what we and our investors want to see. And that encourages us to invest more into this market.
Very good. Thanks, Oliver. I think we're seeing that more and more from investors in the market, looking for those repositioning opportunities and where they can add value. And I think adding their expertise in terms of asset management is really driving value in terms of the uplift that's potential from these new acquisitions that are happening in the market. Vijay, from your perspective, obviously a long history with Arenco Group, very active in terms of assets under management, number of keys under management, and a growing portfolio over the last number of years in particular. From a finance kind of director's lens, like how are you evaluating return on investment of repositioning assets versus acquisition of more stabilized assets where there's little value add?
Yeah, we have the benefit of having different verticals within real estate. Apart from hospitality, we are also into long-term leasing, and also we have our own service departments. We are the pioneers actually under the Golden Sands brands. So we continue to look at potential opportunities for not only rebranding within the hotels segment, we also look at continuous basis repositioning wherever possible, of even conversion of some of our short-term let hotel apartment business into a long-term lease that depends on the location. And that's a process which is an ongoing one. We have our own asset management team who are tasked with ensuring that the assets have the best returns of all. And I think there is a merit in keeping your eyes open for such opportunities, and we are always open to that idea.
Very good. Jamie, look, from your perspective, obviously you're working across various different institutions in terms of supporting with finance for investors in the market. Like, are institutions open to funding repositioning plays today, or are they a bit more cautious?
I think it's important. I think historically in developed markets, it's something that's gone on for a very long time. I think take the example of the HSBC office in Canary Wharf is now being turned into a luxury residential and hospitality offering, right? Those types of deals are seen all the time in developed markets. Dubai has historically been very much a development-led market because of the availability of land. But I do think that given the buoyancy in the build-to-sell residential market, what we're seeing now is land and assets are becoming so expensive to acquire that the institutional capital has no choice. Right. So in order to hit targeted returns, it's becoming more challenging to identify sites to develop and still hit on your returns, particularly if you're looking to hold for the long term.
And what's the scene like in the local banking market? Obviously, we have these conversations all the time. If you're a new investor coming to the market, international investor, are local banks in the market, are they willing to support new investors coming to the market? I know we're having those discussions all the time. They might have a track record in their home country. Are you seeing openness from local banks here to fund those acquisitions, be it value add or a stabilized acquisition?
Yeah, I think for an international investor entering, the banks prefer conservative leverage against stabilized assets. I think coming in and expecting very competitive terms that some of the local players get on development financing is always quite challenging. But I mean, Oliver and the team, for example, what they're doing in the private credit market, some of these international players are seeing an opportunity that the local banks do have limitations in terms of what they can do, particularly for international players. But maybe the likes of these debt funds can have international relationships and take a view and support them in the market. So we're seeing that.
To add on that point?
Yeah, I think we've been active in this market for a number of years. Our setup is very different to, say, what VJ has. We have funds, we have LPs, we can't give guarantees. Go talk to a local bank, the first question is like, who's your sponsor? We have done that with local banks where we've been able to convince them that the fund structure works. It's a slog, it's a challenge. If you go to any other market in the world, the availability of credit for institutional owners, be it through a fund structure, whatever else you want to say, is very, very available. And here it's not. That's why we have been working with like international groups. So our partnership with Oaktree that we've just recently announced. The reason we went with them is not just because there weren't options for us within the local bank market, that there were options, but their availability to be more competitive in terms of what we want to see in terms of like our strategy is value add. So we want like high levels of leverage day one because we're transforming assets, we're growing NOI, so we want to make sure that we're commensurate because for us and our equity, that's what makes sense. That's what we get elsewhere in the world.
Sure.
And so the ability for these guys when they're entering into the market, and now entered into the market, to work with them hand in glove, enables us to go and also be competitive. We're talking earlier today that like the vast majority of our pipeline and transactions that we have done have all been off market. Having these discussions, as a live example of one of our pipeline assets, it's off market, it's there, but we need to be able to move quickly. They don't want to hear that this is going to be subject to bank financing because they know that might be difficult. So we can walk in fully capitalized and be able to execute on opportunities. And so that's what we're really delighted about with our partnership there. And I think the opportunity is there's a lot of capital now available on the credit side, local banks, global capital providers. And I think what we've been able to do with the Oaktree grades proves that. And I think that's going to be more and more common as it is in the rest of the world as the market evolves.
Yeah, it's a further sign of maturity, and we look forward to seeing how things play out. I think it's very exciting, a good marker for the market. Vijay, from your side, like in terms of brands, you're working across very different brands in your portfolio at the moment. In terms of like, what role does brand strategy play in terms of any repositioning decisions that you might have in the future? And I suppose what are the brand expectations? Obviously, you're looking globally at investments as well. And do you see any like difference in the brand expectations in this region for repositioning plays versus, say, in Europe, where maybe you're assessing opportunities at the moment?
Yes, we have the opportunity of working with more than 6 big boys of the world. The brands have their own standards, and we, by and large, try, especially on acquisition related, we try and keep the operators, because any new operators will come with their own PIP, and that PIP seems to be flexible according to the geographical location where they are. The properties are in Europe, the PIPs are considered differently to the Middle East. Yeah, we ourselves have our own internal design team.
Yeah.
We execute most of our works ourselves, starting from the design. So we are able to understand, and in many cases able to convince the operators on unwanted kind of PIP-related issues. But the operators need to be also more kind of flexible or more standardized when it comes to their expectations out of Europe, for example, compared to the Middle East.
Yeah.
So they're willing to accept a different standard for different markets.
Yeah, and I think that we're seeing that as well. It is evolving. The operators are being a bit more, lenient, as discussed even in the previous panel. But there is, I suppose, a lot of differences when you're repositioning in more established markets versus here, and there's a lot of differences in terms of the parameters and the brand standards. When we shift to a bit more about capital flows and investor sentiment, Jamie, how has investor appetite for hospitality assets evolved over the last 12 to 18 months? I suppose especially on the private side from ultra high net worths and family offices. Have you seen much of a shift over the last 12 to 18 months?
Yeah, no, look, obviously, the COVID period is far behind us. I think everyone probably went very slow on hospitality for 2 to 3 years. I think now that shift has turned around completely. I think there are strategic owners who have deep relationships with the big brands, that are doubling down on those relationships, capitalizing on the distribution. I think distribution is something that is a very big focus. So I think that we see the investment focusing either within existing relationships with the big brands where you can get that global distribution. And then the second part is, given the emergence of social media and the ability to unearth unique experiences, that experiential luxury investment is something that we see, particularly from the ultra high net worth, in new markets that perhaps we hadn't considered previously, but where you can unlock a unique experience for a broader group. That's where we see the investment going.
Okay, good. Oliver, just to maybe add from your point earlier, obviously you're very focused on more opportunistic moves. You obviously have competitors in that space too, looking for similar assets. So why do you see kind of a drive in the shift? You've been in the market here for some time. How do you see competitors looking for deals, and how do you see the general market in terms of transactions?
Yeah, I think we welcome competition. It becomes easier. The number of times we'd used to go and pitch to big global capital or LPs and try and articulate that Dubai was a place to invest, their eyes would glaze over. So the more people investing here, the more mainstream it becomes, the easier it becomes for all of us. I think the big challenge for Dubai, which is why we're more on the opportunistic side, is if you look at how Dubai has been developed, just full stop across all asset classes, that other than the government, which have done an exceptional job of building a great pool of institutional quality assets for themselves, be it commercial and DIFC or TCOM or Wassel with their hospitality portfolio, none of that's for sale. And so if you look at the private sector, away from the sort of families such as Aramco, it's all been primarily built to sell developers, be it on the commercial side, hospitality or residential. So there isn't a big depth of stock in institutional kind of quality assets out there. If whatever sector you're in, especially hospitality, if you're that more core focused investor. So our view is that we need to take a step back. If it's on residential where we're developing ourselves, or if it's on hospitality where we're getting our hands dirty, repositioning, doing the work that a more core investor won't do. That's what we're prepared to do, and that's what we're happy to do, and we're set up to do that. We're vertically integrated. We do much as Vijay does. We do everything in-house. That's what our investors need us to do. And that enables us to then basically create, in our minds, the portfolio that, hopefully then we'll be able to take to market to that core plus investor, which is that more sort of if you look at global capital flows, that's what Dubai really needs. It hasn't really achieved that yet. Everything is more on if you look at Brookfield, ICD, it's developing. Everything is more opportunistic at this stage. But I think we're very convinced as our partners that as the market matures, as the product is created, the global capital will come for that more core product.
Very good. Vijay, look, you do a lot of work across different asset classes. At this moment in time, how are you assessing like risk in hospitality, the hospitality market versus other real estate asset classes, which you are assessing and you're looking at, maybe expanding your portfolio in?
Yeah, in fact, all of us had the experience, misfortune in a way, of the negative side of the hospitality industry during COVID. What helped us and many others during the period was the residential and the office commercial side was strong, but hospitality was, so that's a once in a century thing. But I think in a place like Dubai, there are, in spite of all the geographical uncertainties around us, we have always been having growth in tourism numbers. Yes, we had temporary blips. It happened in some of our properties during Indo-Pak issues and then followed by Iran. But the business came back with a vengeance. So we do factor in such thing in hospitality assets. But I think when you are looking at a place like Dubai, which is in Oasis of Peace, it's one of the factors, but relatively a much minor factor.
We've seen enormous increase in sales over the last 24 months. How are you finding, as we are today, in this time in the market, how are you finding pricing in the market at the moment on new opportunities you're looking at?
There seems to be a rush of investors wanting to cash in at the peak. That seems to be this is what I must say, the format for the last 6 months, 1 year. There are a lot of people who put up a price for a property, and as there are potential investors coming close to their expectation, they put up the price even further. And it could be because they feel the market is strong, or it could also be because they feel that it's time to cash out. So, but we obviously go for the location, we go for a long-term commercial value in the asset, never a trophy value.
And Oliver, how are you finding it, pricing at the moment? You see ever increasing divergence between buyer and seller, or are we coming closer together?
I think we're coming closer, thanks to you and Amar and others.
Amar is here for
I think the capital markets activity in Dubai is all-time highs compared to on a global basis.
Correct, yeah.
In fact, that's something which I would like to ask you. Where do you find that equation, and is there a way to bridge? And what?
Yeah, I think overall market sentiment is very strong, and I do feel that owners and investors who have assets feel it is a good time to sell. But I think if you go underneath that, there's various different reasons though. So maybe some owners, they feel like they have some debt in their portfolio, they feel it's a good time to sell, maybe to reduce that exposure. They might be coming to the end of the life cycle of the property as well, and they feel, okay, if we're falling behind brand standards, we need to reinvest here. If I reinvest, we should hold the asset. Now is a good time to exit again. But I think it does come back to the market. There's various different, I suppose, sub-points to making those decisions, but I think overall market sentiment, and people do feel, I think at the moment, it is a good time to sell, given the strength of the operating performances over the last number of years, and I think even in particular this year. So I think it does come back to that. I do agree with you. I didn't think the tables would be turned on me there, but thanks, Vijay.
You made enough commission.
JB, back to yourself on operating models. Are you seeing a shift in investor preference towards like independent models? You speak on it briefly there. Soft branded hotels, or you, as you said, as you think it's a bit still stronger in terms of maybe the larger brands and their core brands. What do you see?
Yeah, I think that as an owner, it's a big challenge because there's so much investment that the big brands have put into IT and infrastructure that it is becoming challenging to compete with that, and the appeal of bringing in them, whether as a soft brand or as a hard brand, just on IT costs purely alone, it looks appealing to get that distribution and that access into that platform. But at the same time, so I do think there will be a continued emergence of either a partnership, whether it's soft or hard, because I think as AI becomes more and more a reason as to how everybody finds a room, right, I think that penetration will become even more important. How are you positioned to capture that AI flow to bring the guests into your room? Is going to become probably the biggest driver of hospitality in the next 4 to 5 years.
Thanks. And just to follow on from that point, Vijay, are you looking to invest in your assets at the moment in terms of like tech integration, looking to kind of reduce operating costs through investment in various different initiatives? on some of your recent acquisitions. How are you looking to future-proof those hotels?
Yeah, I mean, we continue to, you know, improve cost efficiencies in the operating hotel. The margins are certainly under pressure. The operating cost of hotels is certainly going up with a very high turnover of manpower causing one of the reasons. And the rates are under pressure, definitely. So we continue to invest. We continue to invest in a lot of energy saving projects, including GRMS across our portfolio. And we have solar panels. We have our own bottling plants for water. We do our own farming in large properties. And the advantage is when you are able to be a LEED Platinum certified or LEED Gold certified property, we could finance some of those transactions at ESG attractive rates with the banks. And the banks prefer that. Then some of the banks have targets to achieve that, and that helps us also negotiate the rates better. But we do look at ESG. The ESG itself must be on a sustainable basis. Yeah. It just can't be investments made without a return. Yeah. But it's an ongoing process. It's a long way to go. We'll catch up there.
Very good. Oliver, same for yourself. Are you looking to maybe invest in tech, guest experiences, obviously in your recent acquisitions, your plans for the future, your assets?
I think there's probably a lot more smarter people here today been talking about like tech and integration into hotels, so I'm definitely not going to profess to be the expert on that side. I think from what I've seen and what I've been looking at and sitting in some of the talks around how like AI is going to come in and help maybe disrupt some of the OTAs and like some of those things, I think that's going to be a really exciting, interesting space if it does pan out. I think for us, what we always like to do is like, what can we do to the asset where we create a better experience for the guest and without like disrupting NOI. So if you look at, ESG is the buzzword, but if you look at like sustainability, if we can, as we're doing the renovation of our hotels, if we can invest into upgrading MEP systems, energy saving initiatives. If a hotel was built 15 years ago, tech has completely transformed how those hotels should deliver, energy, etc. So upgrading that, and actually that's going to save a material amount on NOI because you're going to save energy costs. I think the other thing that we look at in Dubai is, staff housing. So if you've got like, it's a model which is kind of pretty disrupted. So the owner has the obligation to house their staff. And that's the liability. And if the hotel has been struggling, the hotel owner will typically force the operators to cut costs there. That can create disgruntlement, as you said, a high turnover of staff, it erodes bottom line. So, one of the things we're really excited about, and on our residential strategy, we're hyper-focused on, is creating a much better experience for staff without increasing the cost to the owner, but keeping, without disrupting NOI. What can we do to take strategic initiatives to give a better experience for the staff? And then in turn, that's going to be a better experience to the guests. If the staff are coming to work happy, then they're going to be, in a better mood and in a better ability to serve their guests.
Very good, very interesting. So that just brings us up to the end. I want to thank all our panelists for their insight. I suppose we're very lucky to have such active investors on our panel here today, and those supporting investors like Jamie. I think it's really great to see, I suppose, the market maturing, the increased investment levels, the entrance of new actors into the market, and to bring us on, I suppose, for the second chapter. So thank you to everyone. I think it's a key takeaway that hospitality assets are no longer, I suppose, passive investments. I think we learned that today. The dynamic platforms for value creation, and as I said, we feel the second act is underway. And thanks for listening for the final act of today. That's the end of the panel's discussion. So we really appreciate everyone's support, and thanks for coming out to listen to us this evening. Thank you very much.
Thank you. And